Hi, good morning, everyone. My name is Wei Xiong, and can I have a show of hands who think investing is easy? Oh, I don't see any hands. So who thinks investing is complicated? Okay, I see some. So it seems like many of us here think that investing is complicated. But friends, I want to assure you today that investing can be learned, and it is not rocket science. In fact, for myself, I started to learn about investing when I was just 14 years old. I still remember I was at Queenstown Library and was just browsing around. I saw this book titled Market Wizards. I was wondering, wow, is this as interesting as Harry Potter? And I picked it up, but to my slight disappointment, it was a book that was about a collection of interviews with fund managers. And that inspired me to learn more about investing, and I never stopped since then. So today we have about 30 minutes to cover a lot of ground and learn about investing. So let's begin. Okay. So Sun Tzu once said, know yourself and know the enemy, and you'll be undefeated in 100 battles. So what's the first thing that we need to do? Know ourselves. So what do we need to know about ourselves? First and foremost, it will be our risk tolerance. And risk tolerance is actually determined by two distinct factors: your ability to take risks and your willingness to take risks. Some of these are quite common sense, so I will not elaborate too much. And in any case, before you buy any investment products from the bankers or financial advisors or online platforms, they will likely require you to fill up a questionnaire, and then they will classify you whether you're a conservative investor, a moderate investor, or an aggressive investor. You just need to make sure that you agree with what they classify you as, and that's the most important thing. Okay, the next thing that you need to know about yourself, it will be how much risk are you taking currently? I would like to clarify that this is purely my personal way of looking at my own investment portfolio and how much risk I'm taking currently. So what I do here is that I would classify all my assets according to their risks. The risks I'm referring to are price risk, liquidity risk, and financial risk. What is price risk? Price risk is the magnitude of the price fluctuation. So things like your fixed deposits will have zero price risk, but things like Bitcoins and other cryptocurrencies will have very high price risk. And liquidity risk, it represents how easy it is for you to sell or buy the asset. This is important because you never know when you need your money, so be it for emergency purposes or other purposes. Third will be financial risk. This represents the amount of borrowing that is involved. The higher the amount of borrowings that is involved, the higher the financial risk. So again, this is purely my own way of looking at how much risk I'm taking currently. And after I do this, I will actually draw out diagrams like this. Note that the length of the bars represent the amount of funds you have in that particular risk category. So for instance, if you look at the top right diagram, that diagram would probably indicate that a lot of the funds are parked in low-risk assets, such as fixed deposits or Singapore savings bonds. And on the top left diagram, it shows that actually a lot of funds are parked in the high-risk category. And that actually probably represented my situation when I was young and aggressive and just spent all my money to buy an investment property. I have no cash, no bonds, no shares, just one investment property. So that was when I was young and more aggressive. So I would say that there's no perfect shape or no recommended shape. It all depends on your personal risk tolerance, your own unique situation, and also partly the market environment at that point in time. Oops. Okay. So now that we have known ourselves, let's move on to knowing and learning about the enemy. The enemy is none other than Mr. Market, the temperamental and volatile Mr. Market. So this table shows how temperamental he can be. There are so many meltdowns over the years. And if you look at, let's say, number 7, the global financial crisis, you could have lost 66% of your investments in a one-year period, even if you had diversified across stocks in Asia. That is how volatile and scary it can be. And in the latest episode, the Asian markets are down more than 20%. simply because of the US-China trade conflict. So Mr. Market can be volatile in the short term. But in the long term, he can actually be quite generous if you can learn to live with his temperament. So this table is a very powerful table. What it shows is that if you had invested at the start of every month, and you held it through 15 years, and you disregard all the market noises and market movements, these are the returns that you could have achieved. So let's take a closer look and zoom in on the Asia, Pacific, ex-Japan equities. So how I crunched the numbers here is that I started from 1995, and at the start of every month, I would buy into these Asia equities. And so over the years, there's roughly about 100 trades being done. And the lousiest trade, I repeat, the lousiest trade would have still returned you 100%. In other words, your $1 would have become $2 just by holding on over these 15 years. And on average, a very rough average of these 100 trades, the returns are 200+%, which means that your $1 will have become $3. So this is how generous Mr. Market could be, potentially in the long term. Okay, let's move on to the third characteristic of Mr. Market. He never stays still. He's always either in an up cycle or he's in a down cycle. So these charts show the interest rates and the stock markets in US and Singapore. As you can see, it's always up cycle, down cycle, up and down. And what happens is that the economy will expand, company profits will expand, the stock markets will rise, and after which interest rates will follow as well, in order to keep inflation in check. But interest rates will rise to a certain extent whereby they reach these levels which will start to affect growth. And growth will then slow down, economy contracts, profits fall, stock markets fall, and only then interest rates gradually come down. So this, what I just described, is the business cycle, or it's also called the interest rate cycle. It has happened over and over and over again. Okay, so now we have learned about ourselves and Mr. Market. What shall we do? I think there's 3 Ds that we can do. The first D would be dollar cost averaging. What is dollar cost averaging? Dollar cost averaging simply means investing a fixed sum regularly at a fixed time frame, regardless of the economic headlines or forecasts at the point in time. So when you invest a fixed sum every time, what are you doing? You are actually buying more when the markets are down, and you'll be buying less when the markets are toppish. And so over the long term, you have accumulated your investment holdings at an attractive price, and therefore you will also enjoy an attractive rate of returns. But one word of warning though is that dollar cost averaging works reasonably well for broad market indexes, but it can actually be a danger if you apply dollar cost averaging into single securities. Can you imagine if you had dollar cost average into, let's say, Noble Group? You would have been hurt quite badly. So which brings me to my second D, diversification. These 2 charts show the share price chart of Citigroup and the 5 diversified banks in the S&P 500. You can see the outcome is so different. And therefore, if you want to do dollar cost averaging, you really need to apply it on a diversified portfolio or a broad market index. Okay, now can I have a poll? So please, okay.
So we are present now to facilitate this short Q&A. So can everyone just take out your phone and go to the website menti.com, www.menti.com, and use the code 58989, and can just click on the 5 options. How many of you have invested in the following? Bonds, perpetual bonds, SSB, ETF, unit trust, and as well as REITs.
Yeah, so kindly take out our phone and go to this menti.com and do this live survey. Wow, seems like you are all very active investors. Good, good. Okay, in any case, I'll be quickly touching on all these different asset classes later, and I will actually highlight to you what are the key characteristics for each individual asset class. Okay, maybe in the interest of time, I shall move on, but it seems like all of us have invested in all these various asset classes. So this table shows the risk level of all these asset classes, from the very low risk Singapore savings bonds to the moderate risk like shares and REITs. Okay, let's start with Singapore savings bonds. Singapore savings bonds are a type of bond that is issued and fully backed by the Singapore government. I would say that it is one of the safest investments that one can have. Because price risk, there's no price risk. Liquidity risk is also it's low because you can actually redeem it at the stipulated window every single month. And some other key features of the bond is that the bond will actually pay you a coupon every 6 months, and the coupon will actually step up every year. And note also the minimum investment amount is $500 when you do redeem or subscribe to the bond. So again, this is one of the safest investments that you can have. But of course, the returns are just 2 to 3% per annum. But I think it's still quite reasonable because you are sort of not taking much risk. Okay, let's move on to the other type of bonds. So what are bonds actually? Bonds are debt securities that companies or governments issue when they want to borrow money. So essentially, you are lending money to them. And what does that mean? I want to let you know that lending out your money is easy. It is the getting back part that is difficult, which is why we need to be diligent, which is the third D, diligence. You need to do homework, you need to ask questions, and you need to think about a lot of issues. So what kind of issues we need to think about when we invest in a bond? So first and foremost, I would say that it will be the ability and willingness of the borrower to repay you. The ability of the borrower to repay you, how can you assess that? You can use some matrix, such as how much debt does the borrower currently owe. So you take the borrower's total debt, divide by the total equity, and you get this ratio called the gearing ratio. And another metric could also be how much cash are they generating per year, and whether that cash is sufficient to cover the interest expense. So that's on the ability of borrower to repay you. Next, the willingness of the borrower to repay you. Or you may think, of course they will repay me. They are reputable businessmen. If that's your thinking, I'll tell you you are wrong. Because when things get tough, they will protect their own interests first. And in the last few years, we have seen a couple of bond defaults, whereby the companies are not able to repay their debts. And in most of those situations, they have turned out to be rather ugly. So my advice is that if you do invest in a single name bond, try as much as possible to lend money to those that are really top-notch organizations, whereby their reputation is so important, and they will do everything they can to repay you and safeguard their reputation. So some examples could be Temasek. I mean, if Temasek defaults, then I don't know what to do. Okay, so the next consideration would be, do the returns sufficiently compensate for the risk? What I mean by here is that, so as we have learned in the previous slide, you can sort of lend to the Singapore government at 2 to 3% per annum. So if a small company, an unknown company comes to you and say, I'm issuing a bond, and I'm paying you interest of 4 to 5%, does that sound sufficient to compensate? I don't think so. Okay, so before I move on, I also want to highlight about perpetual bonds. So perpetual bonds are a special type of bonds whereby there is no maturity date. No maturity date. It means that you are lending money to them with no specific time that they need to repay the money to you. You are lending money to them forever. And in return, they will pay you interest. And they will have some things like step-up interest and scheduled call dates, whereby they will be saying something like, currently my interest is X%. If, say, in 5 years' time, I don't buy back my bonds, my interest would step up to Y%. However, the warning sign, a warning is that the issue of the perpetual bond can actually choose to defer the coupon. And they can keep deferring it. And there's nothing wrong with that. So you may end up holding this bond, which doesn't pay you coupon, and will never be repaid. So just need to know, perpetual bonds and your normal bonds are very different. You're lending money to them forever. And moving on, shares. What are shares? When you invest in the shares, you become a shareholder of the company. And shareholders of the company are entitled to the dividends that the company pays out. So let this sink in for a while. As a shareholder, you are entitled to the dividends that the company pays out. This means that the value of your shares will only increase in the long term if the potential dividends that the company pays out increase as well in the long term. So the profits and the dividends are closely related to the share price in the long term. This is sort of a relationship that's held through all this while. And so again, we need to be diligent. There are a lot of issues that we need to think about. So before we are convinced that the company can grow its dividends and earnings over time. So to me, these are the three most important considerations. Number one, the strength of the business. The business world is a highly competitive one and a cutthroat one. And it's about survival of the fittest. So when you invest, do make sure that you're investing in one of these companies, which are the fitter companies. Second question would be, is management honest? And third, how much are you paying for the company? Sometimes I hear people saying that, oh, the shares are cheap. It's only a few cents. But I want to tell you that is a totally wrong concept. Whether shares are cheap or expensive, it always has to be relative to its earnings and assets. So what we do here is we would look at the price-earnings ratio or the price-to-book ratio. So the next time if your stockbroker calls you and recommends you to buy shares, there are some basic questions you need to ask. First, you ask the broker, can you illustrate to me how strong the company is? Second, is management of the company honest and competent? And third, what is the price-earnings ratio and what are the price-book ratio? Of course, there could be more questions to ask, but the gist of the idea is that you need to be assured that this company can grow its dividends and earnings over time. Because only then it will drive up the share price as well. Okay, REITs. When you invest in a REIT, you become its unit holder and you will be entitled to the distributions that it paid out. So this is similar to shares whereby shareholders are entitled to dividends. And for a REIT, it will invest in a portfolio of properties and from the rental income, pay out to you. So what then are the key considerations when we invest in REITs? First and foremost, it will be what are the properties that the REIT is invested in? It could be shopping malls such as your Vivo City, Raffles City, or it could be office buildings like your Marina Bay Financial Center. What you need to think about is, are these properties of good quality and well managed? Because if they are not well managed, there will likely be not much tenants wanting to rent the place, and the REIT would likely have not much income to pay out to you as well. So the most important consideration, the quality of the properties that the REIT is invested in. Number two, the level of borrowing. The lower, the better. Because when interest rates rise, the REIT with a higher borrowing will have to pay more interest, and then it will have less to pay out to you as a unit holder. And one last point on REITs would be rights issue. I think REITs tend to do rights issue from time to time. Essentially what they are doing is that they're asking you to cough up money for them to buy more properties. This is all good if the purchase makes sense. But in recent times, there were several cases whereby the purchases were not that ideal and were actually detrimental to unit holders. So my advice here is that if the REIT you have invested in has done a bad deal before, they will probably do it again. So you would probably be better off selling it and investing it in something else. Mutual funds. Mutual funds are basically people pooling money together and having a fund management company to manage the pool of money by investing in a selected basket of stocks. There's usually a mandate which says that what the fund is invested in. So basically, you are giving money to someone to manage on your behalf. And in that case, what are the key considerations? You need to think about whether the fund management company is credible or not. What's the track record of the fund manager? And how does the fund manager invest? Is he a growth investor or is he a value investor? These questions you can actually ask the bankers or financial advisors who are selling you the products. They should know that. And last but not least, how much fees are being charged? I think in my earlier slide, I said that your $1 could grow to $3 over a 15-year period. That's about 7.6% per annum. But unit trusts, the fund management companies typically charge 1 to 1.5% per annum. So that will actually affect your returns quite a bit. And what's more is that the banks or financial advisors or online platforms that sell you the fund, sometimes they may charge up to 5% sales charge upfront, which I think is daylight robbery. But fortunately, I think recent times there were some online platforms that are starting to offer zero sales charge. And I strongly encourage you to seek those out. So then you don't have to pay the sales charge, but you still need to pay the fees to the fund management companies. I think those fees are somewhat unavoidable because they need to employ a team of people who spend their days researching on economies, on bonds, on stocks, and finding the best investment ideas for you. So those fees are somewhat unavoidable. So overall, I would say that unit trust is quite a good instrument. It's a useful instrument for you to invest in a broad market and to use the dollar cost averaging strategy on. The alternative to unit trust would be exchange-traded funds. These are basically funds which are listed on the stock exchange, and they can be bought or sold just like stocks. They typically charge lower fees simply because they do not need to hire much people, as they just replicate the index and buy across all the index members. So some time back, I wanted to invest in India. But I didn't have the time to go and research who is a good India fund manager. So what I did, I went to buy an India exchange-traded fund. So I would say that ETFs are useful for you if you do not have the time or expertise to search out for the good fund managers that do justify their fees. One more thing on ETF is that how they replicate the index. Some buy the securities direct, and some use derivatives. I tend to find that those that use derivatives fare poorly in the long term because of some additional rolling costs using the derivatives. All right, so as I mentioned, the third D was diligence. So there are a lot of questions that you can ask, but I would encourage you to go to the Money Sense website for a more comprehensive list of questions that you should ask before investing in anything. Okay. So we have covered a lot in the last 30 minutes, and here are the key takeaways. I strongly encourage you, when you get home later, to do 3 steps. The first step, make sure that your risk tolerance and the current risk that you're taking match. So first you need to determine your risk tolerance, then you map out how much risk you're taking. Make sure they match, because you should never take on more risk than you can afford to. The second step is to make sure that your portfolio is well diversified and you know all the products that you're currently invested in. So if you have single stocks, you have single bonds, you have single REITs, think hard about those questions which I mentioned just now and assess for yourself whether these investments make sense or not. And for the unit trust or exchange-traded funds that you own, again, think about whether are they investing in something that you really want, and do they justify their fees? The third step would be to consider starting a dollar cost averaging plan. You need to think about how much investments you want to commit and how frequent. It can be monthly, quarterly, or even annually. And going forward, every time when you invest that fixed sum of money, there are two things to think about. One would be, should I just simply add on to my existing holdings? Or should I add on to something new that will further diversify my portfolio and make my portfolio even more resilient? So 3 steps. Ensure the risk you're taking matches with your risk tolerance. 2, ensure your portfolio is well diversified and you know all the products. And 3, consider a dollar cost averaging. And every time you invest, think whether you should add to the existing holdings or add something new that can further diversify and add resilience to your portfolio. So with this, I think your portfolio will be well on track to grow over time. Okay, I would like to leave you with a final thought. So imagine this, your neighbor is currently 3 times wealthier than you. Every dollar you have, he has $3. But if he doesn't invest his money, or you invest your money sensibly, over a 15-year period, your $1 will have grown to $3. He will still be $3. You will now be on par. And if we fast forward another 15 years, your $3 will become $9, while his $3 will still be $3. So this is the power of investing and compounding. So friends, I hope that I will strongly encourage you to spend some time and learn how to invest in a sensible and prudent manner. So thank you so much, everyone.